Hello and welcome to the DIY Investing YouTube channel. We are going through every company in the S&P 500 and today is the Allstate Corporation. In the next 5 minutes, I will go over my valuation thoughts for this company and my thoughts on the business quality for Allstate. Let's dive right on in. First up, this is an insurance company, and I've heard of this, so I think I already know a little bit about what it does, but let's go into what this company does. The company operates through Allstate Protection, Protection Services, Life Insurance, Benefits. So they offer auto insurance, homeowners insurance, specialty auto, motorcycle, trailer, motorhome, off-vehicle insurance. We have renters and homeowners insurance. Commercial lines include Allstate Encompass name. All sorts of insurance, including life, illness, various things like that. So this is a broad insurance company that we can learn from. So there's going to be a little difficult looking at individual lines because you're not going to see it in these broad financials, but we'll see what we can see from it. So the beta here is 0.85. That's significant because it's a lower volatility than the overall S&P, and the share turnover is not important here. So return on equity is what I like to see. It's going to be a little bit difficult because it's going to look cyclical like all insurance companies because every once in a while you're going to have losses. The last time that they had a loss, it looks like was 2008. That's significant because that was a recession. And so, but otherwise in the last 20 years, they've only had 1 year with loss. That's acceptable. Return on equity fluctuates around 6%, 15, 23, kind of comes down to 5, 11. You've been kind of in the double digit range since 2000. No, not 2000, since 2012. But a little bit all over the place. I don't like the instability of the return on equity. It makes it hard to predict for me. The return on median returns, return on equity at about 11%. Again, this is low. And now the insurance company is a little different because they leverage up. And so some of these way of thinking about it is different. Price to premiums, 0.8, PE, 21.6. Again, these numbers fluctuate over time, so it's a little difficult here. What we want to see, though, is what's the growth rate in premiums over time and growth rates in EPS. So your premiums growing about a 4.6%, EPS growing about 12.7% across the 10 years. That's pretty good. The median margins on underwriting and pre-tax income to give us some idea of their underwriting piece here. So revenue is not really as important as premiums. Premiums is what matters here, and so you can see the premiums growing from 28 billion to 44 billion. Again, this is a huge company in 2021, so they don't really even double, and that's that 4.6% rate. So it's pretty slow growth industry, slow growth company here. The underwriting profit has doubled from about 5 billion to 10 billion, and so that's a good underwriting profit margin over time. And you can see so something weird here is happening. So you have earnings per share $4.68 to $4.96. So that's not entirely accurate. If you just look across here, it looks like it tripled going to 2020, but 2020 was weird because of the pandemic. People drove less, so there's some instability there that you can think about. Maybe a better way of thinking about this is dividends per share has more than tripled from 88 cents to $3.24. And so you can see that's probably a better, more easy way to think about the long-term predictability here. So if we go into the income statement, we're going to see, let's see here. So your claims against your premiums, and that's where you're going to get this pre-tax income piece. Let's see, net income. All over the place, hard to predict. The thing that immediately leaps out to here is the shares diluted has crashed. It's gone from 493 million shares out diluted to 299. So they've been buying back copious amounts of shares. It looks like they're buying back every year and making a massive dent in this company's share per shares, which I really, really like to see. Let's see here. So your securities and investments. One thing that's hard to do with QuickFS, and so you'd have to do it with any insurance companies, you really want to understand what their investments are. Shows your exposure to bonds versus other types of investments. Because really that's what you're buying when you buy an insurance company. You're buying their underwriting record and you're buying their investment portfolio. And so it's really hard to parse right here. But in terms of cash flow, what I want to see is what are they using with their cash? So Cash from operations has been positive every year for the last decade, which is really nice to see, going from $3 billion to about $5 billion. We're going to compare this number against that market cap earlier. But what you can see is they're buying back shares every single year. $1 billion, $1.8 billion, $2.3 billion, and it's continuously buying back shares and dropping that share count, which is really nice to see. In addition to buying back shares, they're also paying a lot in dividends out every year. And so this is clearly doing well from a cash flow perspective and how they're spending your money to retire their shares. So we said that there's like $5.5 billion in cash from operations. We compare that to a market cap here of 34 billion, EV of 41 billion, and this company looks pretty cheap. I like what I see there. It's clearly being managed for shareholders' interest with those buybacks. Any insurance company is going to require a lot longer of an analysis, and so despite low premium growth, they're turning that into a very strong EPS growth because of those buybacks. So you're able to use this return on equity, getting into the double digits, to really drive a double-digit EPS because they're buying back their shares, especially when their prices are low, and just retiring the company shares over and over. They recognize there's not a lot of growth here, and so they've probably maxed out a lot of their market share, and they're in a really strong setup to buy back shares over time. So I actually like what I see here. I like how this business is developing over time. I think Allstate would go onto my watch list because of how they're managing their cash flow. Again, anytime you do an insurance company, QuickFS is not going to be sufficient. You're going to have to do a lot more work trying to understand how they manage their investments, how they manage their cash flow, and what their underwriting's like, how they position themselves in the industry. But in this first 6 minutes, 7 minutes look at the company, I'm interested, and I think it would go on a watch list for me. It's too early to say, but the valuation looks good because, again, we had that $5 billion in cash flow against a market cap of 30, so about 7 times price to cash flow, which is very attractive. So hit that like button on this video. Don't forget to subscribe and ring the bell in order to get notifications as I upload new videos each day, working through the entire S&P 500. Thank you for listening, and until next time, stop paying fees, start building wealth.